This is Coins, Cashflow, and Conversations podcast. I am your host, Dakota Grady, sponsored by Upstate Essential Solutions. Contact me today if you need help with accounting and taxes and personal finances. The website is dakotagrady.com. And while you're there, I want to encourage you to get the free resource to help you save money in your business with tax strategies. Click on the tax solution page and get the freebie about tax strategies for your business to save you money. Welcome to the show today, y'all. And it's Friday. It's the weekend, baby. That's right, y'all. Today we're going to continue talking about entrepreneurship, talking about the income statement or profit and loss, P&L, as people may say, talking about accounting. So what is a profit and loss statement and why is that important? Well, I'm going to share my screen with y'all and hopefully, I won't be able to share my screen, but basically, P&L is a statement that is important in accounting. Accounting is the language of business. Business is something that we all understand or know about business, whether it's for profit or non-profit. But every business needs accounting. Accounting, again, language of business, how much a business has actually spent, income or expenses, and earned its income. And then you want to know about how much a business or how business financed, how are the assets, the things that business owns, how are they financed? Well, they're financed by either equity, the owner, debt, right? Loans, and then also income from the business. In a nutshell, what accounting is. So you're taking accountable for any income you've made, expenses you've spent, and then how your business is financed, either through equity, the owners, or debt, liability, and also how the income is generated to produce or support those assets too. So I'm talking about the P&L, profit and loss. And basically it shows how much a business has spent for or earned and spent for a particular period. So you start with income. You may have sales from selling products and services. You may have other revenue as well. So you may have different streams. So I do accounting and taxes. So I do speaking, coaching, I have book sales, I have an audio book, I have consultations. So all of those are income streams, right? So if I have, for example, $100,000 of income from all those streams, say each one of them may have been, so I got 10 streams of income. So each one provides $1,000 or $10,000 of revenue, for example, all right, for the month. I'm using it as a monthly. All I'm going to do for a year. So 100K for the year, and then you got basically 83.34 per month, roughly. All right. So again, we'll keep it simple. Each stream brings in about, if I do 10K a month, that's 120 for the year. So we do 120 for the year, for example, and I got 10 streams of income within my business. Each one of them provides $10,000 per stream. That's 1K, $120,000, right, of income. So with that, any income that you earn is taxable. So you have gross income, and then if you have, say, products that you're selling, you have cost of goods sold, which basically is the cost of the goods that you actually sell. So for example, you're buying inventory and say you're buying widgets for $5, right? But when you sell them, you may sell them for $10. So basically the difference would be $5. So you moved off the inventory from the books and then you capture the cost too. So $5 for the cost of it is basically debiting the expense for the cost of goods sold, credit in cash, right? You don't do a cash basis, right? And then on the upside, if you're doing, and then once you sell it, you would basically debit cash and credit the sale, all right? So you're increasing your income, right, by the sale, but you're also removing the cost of that from the books. Now, if you're using accrual basis accounting, right, you basically you're debiting the expense, right, or the inventory, right, and then you say you do it on account. So you debit the expense, right, or so you debiting inventory, and then you're going to credit. Say you're going to do accounts payable, right, because you're doing it on account. But when you sell the asset, that inventory, you would again, say if somebody buys it for you from you on an account receivable. So you would basically debit the AR for the particular inventory that you're selling to someone and credit the sale, right? So you debit account receivable, credit the sale, and then on the opposite side, you're going to remove the inventory from the books. Debit cost of goods sold, credit inventory, right? So again, you're going to capture that on income statement and the balance sheet. You're going to capture the income that you earned from the sale on income statement, and the balance sheet will reflect on the inventory being removed from the assets. So again, focusing on the income statement, but income statement and balance sheet, they go hand in hand, they work together. So again, back to the cost of goods sold, it's basically capturing the cost of the inventory that you sold on the books, right? On the account records. So you have your income minus cost of goods sold, and that gives you gross profit, right? So gross profit is basically what you have left over to pay for any other expenses that you may incur for your business. And it's called basically general and administrative costs, expenses. So you have office expenses, advertising, you may do meetings with your team. So you have team people, you have payroll expenses, you're paying out for payroll, you may have contract labor, and you also may pay for things such as subscriptions to your business. So you may have like subscriptions for like Microsoft Office, Canva, you're using that for doing marketing, for creating flyers. So different expenses that you have that offset the income. All right. So once you have the total income minus your cost of goods sold is your gross profit. And then after that, you reduce all your other expenses, or you're reducing gross profit from your other expenses, and it gives you net profit or either net loss. That's what's called the profit and loss statement, because you either have profit from the business or loss from the business. Either way, you're going to receive how much you made from the business, all income, all right, minus your expenses. So if you have more income earned and less expenses, you have a net profit. So for example, we had 120 that we earned for the year in our business. And then what if we have about, I want to keep it simple, $20,000 expenses. I know this unrealistic, especially have employees, but I'm going to use this as an example. So you have 120 income after all the expenses, 100K, right? So your net income after all your expenses will be 100K. And I'm actually making it more realistic. Let's do 120th income total. And then after all expenses, including your cost of goods sold and any other expenses, such as your general and administrative expenses, your total net income, I'm gonna do $50,000. All right, keeping it simple. So you'll pay tax on $50,000 and not $120,000 because your expenses reduce your income. So when you file your taxes, you will pay taxes on $50,000 compared to $120,000. That's why it's important to make sure you do bookkeeping for your business. That way, when you do your bookkeeping for your business, you'll be reducing your taxable income by having expenses. And when you do your bookkeeping, you'll know that every single month. So I recommend doing bookkeeping, not yourself, but hire someone to do it for you, to do bookkeeping for you, so that you will know your numbers every single month. You know how much you're making and spent for your business. Now, on the flip side, what if you made $50,000 for the year, and after all your expenses, you had a net loss of, say, $25,000? That means you spent more than you actually earned. You spent $75,000, but you only earned $50,000. So the net result would be a negative $25,000 in your net income. Now, this is important because you can offset your net losses in your business against your active income. So you have a job, you get a W-2, right? W-2 in your business, or W-2 if you're working for someone else. Say if you work for yourself, so you got an S corporation, but you also work for your S corp and you're an employee. So the losses from your business will offset the income that you earn from working in your business as an employee. So that's important to know, because again, your losses can offset your active income, which is your W-2 wages. So again, the profit and loss is very important. And whenever you want to get a loan, I don't recommend doing that. But if you want to get a loan, the loan officer is going to want to ask or want to see the profit and loss statement, so he or she can know that you are making money to be able to repay the loan. So this is important. Every business needs bookkeeping and accounting. Bookkeeping is basically when you compile all the information, put it into a software or spreadsheet, and you get a result. When you use that information and create financial statements, the profit and loss, and balance sheet, at that point, you're categorizing those expenses and income and any purchases you made for the business, and you're telling the story. You're putting those in a statement saying, this is how much we spent, earned for a particular period of time, for the month, quarter of the year. And then you're saying, all right, this is what we can afford. For example, if we want to get a loan to repay based on the income we've earned from the business. So you're showing someone that you have made money or lost money, depending on if you made too much money or made more money than you spent or spent more than you made. Again, net profit or net loss. And that basically represents how profitable you are in your business, your bottom line, which is basically the P&L, profit and loss. So I hope this was helpful to you. I hope you understand what a profit and loss is. Income statement, same thing, just different words of saying what it is, but showing how much money you earn and spend for the business. You either have a net income, positive amount, you spent less than what you've earned, or you have a net loss, you spent more than you earned. So this is very important for any business, whether you're for profit or nonprofit. So this is the Coins Cash Flow and Conversations podcast. Hopefully this was helpful to you to understand what a P&L is for your business. If you need help with your accounting and taxes, you're a transportation entrepreneur, med spa owner, or an esthetician, contact me today at dakotagrady.com. And if you need help with accounting and taxes for your business and you want to talk about advisory as well, see how we can help your business grow, dakotagrady.com is the website again. And for your personal finances, I got your back too. dakotagrady.com is the website. Click on the Tax Solutions tab and get the freebie to help you save money in your business with tax strategies. Again, this is the Coins Cash Flow and Conversations podcast.